Okay, stop what you are doing. Seriously, put the coffee down, pause the other notifications, and just look at your screen.
Yeah, take a breath.
It is Wednesday morning, February 11th, 2026. And if you are holding indices, I mean, if you're in the Dow, the S&P, or the NASDAQ, you are having a very, very good morning.
A fantastic morning.
The headline number is in, and it is a monster. The U.S. economy added 130,000 jobs in January.
It's a massive beat, a huge beat. We were looking for something in the range of, what, 68,000 to 70,000?
Around there, yeah. Some of the bears were even calling for a negative print.
I saw one forecast for a loss of 10,000 jobs. So to get 130K, I mean, that's nearly double what the consensus expected.
The market loves it. Green arrows everywhere. It feels like a touchdown. But, and you knew there was a but coming because we are Theta Fuse and we don't just read headlines, there is a skeleton in the closet.
A massive, dusty, rattling skeleton that the Bureau of Labor Statistics just dragged out from under the bed. That's right. And it's such a perfect analogy because while everyone is cheering the touchdown scored this morning, the referees have effectively gone back to the previous game.
The whole season.
The entire previous season, actually, and erased the score. We have to talk about the revisions. They are deep, they are drastic, and, you know, they really change the entire narrative of the economic recovery we thought we were living in.
We are going to unpack all of that. Welcome to Theta Fuse, the deep dive for active traders who want the alpha without the headache. I'm your host, the guy who reads the footnotes so you don't have to.
And I'm here to help connect the dots. Today, we have a packed roadmap. We are breaking down this Super Bowl of jobs reports.
It really is.
We're also going to talk about the K-shaped economy, why Ferrari and Marriott are popping champagne, while, you know, Mattel and Kraft Heinz are practically crying in the corner.
And we have to talk about the AI debate. Is software dead? Jensen Huang, the godfather of AI himself, stepped into the ring this week to defend software stocks. We'll tell you why he thinks the sell software trade is, well, he called it illogical.
Plus, we've got a strategy of the day that is tailored specifically for this split-screen economy. How do you actually trade the widening gap between the haves and the have-nots?
Exactly. But let's start with the big one, the macro picture, the Super Bowl of jobs reports. Bank of America actually called it that, didn't they?
They did. And for good reason. This wasn't just any old monthly update. This was the moment where the government benchmarks all its survey data against, well, actual tax records.
A moment of truth.
The moment of truth. To see if their estimates from last year were even remotely correct.
I was looking at the terminal this morning, specifically at the reaction to the payroll print, and it really feels like we're living in two parallel universes.
How so?
Well, on one screen, you've got the algos chasing the headline, number 130,000 jobs, boom, the market goes vertical. But on the other screen, you dig into the actual footnotes of the BLS release, and it looks like a crime scene.
It's cognitive dissonance at its finest. You're talking about the benchmark revisions, of course.
The revisions, exactly. But before we get into the scary stuff, let's ground this for everyone. The headline was 130,000 for January 2026. The consensus was looking for, what, 70,000?
Roughly 68,000 to 70,000. So purely on a beat basis, this is a massive upside surprise, almost double expectations. And if you're an active trader just scalping the SPY or the QQQ, that's all you cared about at 8:30 a.m.
That's it. Green number, click the buy button.
Green number, buy button. The unemployment rate also held steady. It ticked down slightly to 4.3%, which optically suggests the labor market is tightening again.
Optically. That's the key word, because this is where the deep dive really starts. I saw the note about the benchmark revision to March 2025. The BLS basically said, oops, we overcounted.
A little more than an oops.
But looking at the scale of it, they took the growth from nearly 600,000 all the way down to 180,000. That's not a rounding error. That is a fundamental model failure. Walk us through what actually happened there. Why is that gap so incredibly wide?
Okay, so it all comes down to the methodology, and this is something traders often gloss over, but it's so critical for long-term positioning. The monthly jobs numbers we obsess over, the NFP print.
Right.
Those are based on the CES, Current Employment Statistics Survey. It's a survey of about 122,000 businesses and government agencies.
It's a survey. It's a poll.
It's a poll, and it has a flaw, a big one.
Right.
It struggles to capture the birth and death of companies in real time.
The birth-death model. That's where they basically have to guess how many new businesses opened up or how many closed down in a given month.
Essentially, yes. They have a statistical model that estimates net business creation. So if they think the economy is strong, the model adds a bunch of phantom jobs to account for all the new startups they can't survey yet.
And if they think it's weak, they subtract jobs.
Exactly. But it's an educated guess. It's an estimation. But once a year, they reconcile that survey data against tax records, specifically from the QCEW, which is the Quarterly Census of Employment and Wages.
Now that sounds more official.
It is. The QCEW is hard data. It's based on the unemployment insurance tax filings from nearly every employer in the country. It's not a survey. It's not a guess.
So the survey was the guess, and the tax records are the receipts.
That's the perfect way to put it. And the receipts show that for the year ending March 2025, the U.S. economy didn't create 584,000 jobs.
No.
It created 181,000.
That is just staggering. I mean, let that sink in. They were off by over 400,000 jobs. If we take out actual recession years, isn't that the weakest job growth in, like, decades?
Since 2003.
Yeah.
Think about that. We spent all of 2025 hearing about a resilient consumer in a tight labor market. The Fed was making policy decisions, major interest rate decisions, based on that data.
Companies were setting their full-year guidance based on that data.
And it turns out we were actually moving at a glacial pace. The whole narrative was built on a foundation of sand.
This is the sports analogy I was thinking of. It's like your team wins the Super Bowl, the final score's 30-0, you're celebrating, confetti is falling, the whole city's having a parade. Right. And then the next morning, the league commissioner comes out and says, hey, great game yesterday, you won. But upon further review, we realize you actually lost every single regular season game you thought you won last year.
That is a perfect way to put it. It completely rewrites history. And it creates this cognitive dissonance in the market.
It has to.
The market is trading on that 130,000 number for January 2026. Traders are saying, okay, the past was way worse than we thought, but who cares? The past is the past. Today, we are adding jobs.
But this is what bothers me, though. If the model that produced the 2025 data was so fundamentally broken, why are we supposed to trust the 130,000 number from January 2026? Isn't it just fruit from the same poisonous tree?
That is the billion-dollar question, or perhaps the trillion-dollar question for the bond market. There is a huge credibility gap opening up.
Right.
However, the market is, for better or worse, a forward-looking machine. It sees 130,000 jobs now, and it sees an unemployment rate that isn't spiking out of control at 4.3%. It's choosing to interpret this as, okay, the soft landing is messy, but we are still landing.
It feels more like the market is just saying bad data is better than no data.
There's some of that, too. But I did see Kevin Hassett out there spinning this before the numbers even dropped. I caught him on one of the morning shows.
Yeah, the former National Economic Council director. It felt like preemptive damage control.
It was absolutely expectation management. The administration knew this revision was going to be ugly. Hassett's argument was essentially this. The labor force is shrinking because of immigration policy changes, so we don't need as many jobs to keep unemployment low. He was also talking about a productivity boom.
Okay, let's break that down. Is there any validity to that, or is that just political cover for a bad report?
Well, there's a grain of truth regarding the denominator, the size of the overall workforce. If you shrink the pool of available workers, you can mathematically have lower job growth without spiking the unemployment rate. That part is true.
Okay.
However, the productivity boom argument is a lot harder to square with the earnings we're actually seeing from the industrial sector, which we'll get to in a bit. If companies were truly that much more efficient, we'd be seeing better margin expansion across the board, especially in the mid-caps. We just aren't seeing that everywhere.
So if I'm a trader trying to build a thesis here, the takeaway is the soft landing narrative might have actually been a stall speed masquerading as growth.
Correct. We didn't crash the plane, but we were flying barely above the trees for most of last year. And that makes the entire economy incredibly sensitive to any kind of shock, any turbulence.
Fragile, but not fragile for everyone. And this is the perfect transition to our second segment. We always talk about the economy like it's this one single monolithic thing.
It never is.
But looking at the earnings that came out alongside this jobs report, it is crystal clear that we are living in two completely different economic worlds.
We are seeing the textbook definition of a K-shaped economy play out in real time.
Let's get right into it. This brings us directly to the corporate earnings. Because if the economy was actually stalling for the average worker in 2025, as those revised jobs numbers suggest, then the earnings reports we got yesterday and this morning make perfect sense.
They click into place.
We keep using this term K-shaped. I feel like it's becoming a bit of a buzzword, so let's actually unpack what it looks like on a company's balance sheet.
Yeah, it's a great visual, the letter K. It's the visual representation of inequality. The top arm of the K is shooting up and to the right. That represents asset owners, people who own stocks, real estate, businesses.
Our wealth is growing.
Right? And the bottom arm of the K is trending down. That represents wage earners, people who rely on a paycheck. Inflation hurts wage earners. It often helps asset owners, at least initially, by inflating the value of their holdings.
And nowhere is that starker than comparing Ferrari to Mattel this morning. I want to start with Ferrari ticker Race E. They are up, what, nearly 10% this morning?
Around 8 to 10%, yeah. It's a huge move for a company that size.
But it wasn't just the revenue beat that caught my eye. It was the mix of that revenue.
The customization rates.
Yeah.
That is the key metric for Ferrari watchers. It tells you everything.
Explain that for the listener who, isn't specking out a new Pura Sing this weekend.
So Ferrari sells you a car. That's the base price, the MSRP. But the real margin, the real profit, comes when the buyer starts adding the options. The carbon fiber trim, the custom leather stitching, the personalized paint color.
All the extras.
All the extras. Ferrari noted in their call that their personalization revenue is at record highs.
Which means their customers aren't just buying the car, they are ticking every single upgrade box without even looking at the price. They are completely price insensitive.
Totally inelastic demand. If you have the liquidity to buy a Ferrari in the first place, the interest rate on a car loan is completely irrelevant to you.
You're paying cash.
You're probably paying cash anyway. And look at their margins. Their EBITDA margins are hitting 39%.
39%. That's not an automotive manufacturer. That's a luxury fashion brand. That's Hermes territory.
That's exactly it. They aren't a car company. They're a luxury goods company that happens to make cars.
But someone might say, okay, that's just a niche. I mean, how many people actually buy Ferraris? Why should an active trader care about a company that sells, 13,000 cars a year?
Because it's a barometer. It's a canary in the coal mine for the health of global liquidity and the wealth effect.
Explain the wealth effect.
The wealth effect is the idea that when people's investment portfolios and real estate values are up, they feel richer, and therefore they spend more freely, even if their income hasn't changed.
So the stock market going up makes them more likely to buy a supercar.
Exactly. Ferrari's results confirm that the top 1%, the top 5% are absolutely flush with cash. And we have to remember, the top 10% of households in the U.S. control a massive percentage of overall consumption. Their spending moves the needle.
And it's not just cars, though. It's experiences. Let's talk about Marriott, ticker MAR.
This one was fascinating. Marriott's CEO, Anthony Capuano, he didn't mince words at all. He explicitly used the phrase K-shaped economic bifurcation on the earnings call.
You almost never hear a CEO be that direct about inequality.
It's rare. He just came out and said it. He called it out. He said luxury hotels and high-end experiences are booming.
Right. I think the quote was extraordinary demand for travel and experiences. He believes this is a permanent post-COVID shift.
A structural shift where consumers, specifically those with money, are prioritizing a trip to Europe or a luxury resort, stay over buying more hard goods like furniture or electronics or even cars.
So if you have money, you're buying a Ferrari or you're booking a suite at the Ritz-Carlton. What about the, let's call it the affordable luxury category? I saw Spotify is also having a great day.
Spotify, ticker SPOT, is up about 10–15%. This one falls into a really unique spot. It's not a Ferrari, obviously.
Yeah.
But for a huge swath of the population, music streaming has become a utility, or at least a protected, affordable luxury.
They just raised prices, right? That was a big test.
They did. And that was the whole question for them. Can they do it without churn? Premium subscription prices went up, and yet their premium subscribers grew by 10% to 290 million.
So it worked.
It worked. This shows incredible pricing power. It tells you that even if people are tightening their belts in other areas, they are not canceling the soundtrack to their lives. It's sticky. It's embedded.
Okay, now let's pivot. Let's look at the other side of the screen. Let's go to the bottom of the K Mattel, ticker MMAT, down 25%. This isn't just, we missed a little. This is a collapse.
It's a bloodbath.
Yeah.
An absolute bloodbath. And if you read the transcript from their call, the CEO, Yanon Kreis, he sounded careful. He was trying his best to frame it as a tough macro environment, but the numbers, especially the December billings, tell the real story.
And December is everything for a toy company. That's a Super Bowl for them. If you miss December, you've missed the entire year.
Exactly. And the fact that billings were down implies that the retailers, your Walmarts, your Targets, they stopped ordering. And why did they stop ordering?
Because the inventory wasn't moving off the shelves.
It wasn't moving. This connects right back to the jobs report revisions we talked about.
Yeah.
If the average worker's job security was weaker in 2025 than we all thought, and if we know credit card delinquencies are rising, which they are, hitting levels we haven't seen since 2011, then of course the first thing you cut is the discretionary toy budget.
You have to. You buy the food, you pay the rent, you keep the Spotify subscription.
You keep the essentials and the sticky, low-cost luxuries.
But you don't buy the new $200 Barbie dream house. Maybe you buy the knockoff from a discount store, or you just buy nothing at all.
And this really exposes the danger of looking at the S&P 500 as a perfect proxy for the economy. The S&P is market cap weighted, so it's dominated by the giant tech companies at the top of the K. But a company like Mattel is telling us about the real health of the median American household.
That's a great point. And look at Kraft Heinz, KHC. This is the grocery aisle. You'd think food is a safe haven, a defensive stock.
You would think. But their stock is down, and they announced they are pausing their plan to split the company.
Why pause the split? That seems like something the market wanted.
Because they have to spend a ton of money to fix the core business first. They committed $600 million to marketing and pricing.
So price cuts and more ads.
Basically, yes. They are losing the price war on the shelf. People are trading down to store brands, or they're just buying less packaged food in general. Kraft Heinz now has to spend a fortune just to try and win those customers back. That is a classic sign of a tapped-out consumer base.
Wow. So we have Ferrari on one side with 39% margins because their customer literally does not care about price.
And on the other side, you have Kraft Heinz destroying their own margins because their customer cares about nothing but price.
That is the K-shape in a nutshell. And as a trader, this is so important. You cannot play reversion to the mean here. You can't just assume Mattel is cheap because it's down 25%. If the structural consumer weakness is real, Mattel isn't a value play, it's a value trap.
It could be. And then there's Lyft, ticker LYFT, down about 15% this morning.
Another one at the bottom of the K.
A surprise operating loss. They lost $188 million when the street was actually expecting a small profit. Ride-sharing is very price-sensitive. If an Uber or Lyft ride to the airport costs $40 and you're feeling squeezed financially, maybe you take the bus or you get a ride from a friend, you don't go.
It's a discretionary service.
Exactly. So we have this incredible divergence. Ferrari and Marriott are partying like it's 1999. Mattel and Lyft are waking up with a massive hangover. And then there's a company like Ford right in the middle.
Ford, ticker F. What's their story?
Ford is an interesting case because it sits right in the messy middle. They missed profit expectations. They lost billions with a B on their EV unit, the Model E division.
So the big EV push isn't paying off yet.
Not even close. And it just reinforces the point. Selling mass-market hardware, whether it's a toy car like a Hot Wheels or a real car like a Ford Mustang Mach-E, is incredibly difficult right now compared to selling luxury experiences or essential software.
It's a tale of two economies. It's not one economy. And if you're an investor, you cannot just buy the market. You have to pick your side of the K.
Absolutely. The concept of the average consumer doesn't really exist anymore in this environment. You have the consumer who is debating which customization options to add to their Ferrari, and you have the consumer who is debating whether to buy a Barbie doll or pay an overdue utility bill.
It's that stark. We're going to talk about how to trade that gap in our strategy segment later on, but first.
Yes, before we pivot over to the tech sector, a quick word for all of you listening.
If you are finding value in this breakdown, if you like that we read the footnotes and connect the dots so you don't have to, make sure to comment and subscribe to Theta Fuse. We are building a community of smarter traders, and we want you to be a part of it.
And here is your favorite section. If you need a deep dive analysis on a specific stock symbol, maybe you're holding a bag on Mattel and want to know if it's time to fold, or you're looking at Ferrari and wondering if it's too late to get in, drop the ticker symbol in the comments. We'll pick the best ones to feature in our next deep dive.
Please do it. We read every single comment. Okay, let's pivot. We talked about the macro mess. We talked about the split consumer. Now let's talk about the engine of the market, tech and AI.
And this has been the hottest debate on Wall Street for weeks now. The narrative going around has been pretty simple. Software is dead.
Right. And the logic on the surface kind of makes sense. It goes, AI can write code, AI can build apps. Therefore, why do we need all these SaaS software as a service companies?
Why pay for Salesforce or Adobe or Chegg if an AI agent can just do it for free?
Exactly. And investors have been dumping software stocks like they're radioactive because of that fear.
It's been a brutal, brutal sell-off. If you look at the iShares Expanded Tech Software Sector ETF, the ticker is IGV, it has been in a free fall. But this week, that narrative hit a brick wall. And that brick wall's name is Jensen Huang.
The CEO of NVIDIA, the man in the iconic leather jacket, he came out swinging this week. He didn't just defend software, he went on the offense.
He did. He called the idea that AI will replace software illogical. In fact, his exact words were something like, "It's one of the most illogical things I've ever heard."
That's a strong statement from the guy who is literally building the brains for the AI revolution. Let's unpack his argument. What's his reasoning?
He used a cooking analogy, which I thought was pretty clever. He's saying AI replaces software is like saying a better oven replaces the need for ingredients.
Okay, I like that. The AI is the oven, the software is the ingredients.
Exactly. The AI, the hardware, and the models just makes the cooking faster, more efficient. It doesn't eliminate the need for the raw materials, which is the software code and the business logic.
Oh,
But let's strip away the metaphor and look at the actual tech stack. His core argument is that AI is an accelerator of compute, not a replacement for the workflow.
what's the difference? An accelerator versus a replacement?
Think about a company like Datadog, ticker DDOG. They just reported a monster quarter, and the stock is up 15% today.
Huge move. So what does Datadog actually do?
In simple terms, they monitor cloud infrastructure. They are the dashboard for the IT department. They track server logs, application performance, security threats, all of it.
Got it. They make sure the website doesn't crash.
That's a big part of it. Now think about this. If every company on the planet starts building and deploying their own AI applications, running large language models, running inference models, does their cloud infrastructure get simpler or does it get more complex?
Oh, exponentially more complex. I mean, you have way more API calls, more data moving back and forth, more potential security holes.
Exactly. So do you need more Datadog or do you need less?
You need more, a lot more.
You need a lot more. AI is a chaotic force for IT infrastructure. Chaos requires management. Management requires sophisticated software. That's why Datadog is winning. They are selling the seatbelts and the fire extinguishers for the AI rocket ship.
That makes perfect sense. Now, let's contrast that with the counterexample, Chegg, ticker CHGJU.
Chegg is the cautionary tale. The poster child for the AI is eating my lunch story.
Why? What was their core business?
Their core value proposition for years was simple. We have the answers to your textbook questions. If you were a student stuck on a homework problem, you paid Chegg a subscription fee to get the solution.
Which is exactly what ChatGPT and Gemini now do.
And they do it for free, or at least it's bundled into a subscription you probably already have anyway. Chegg's product was a wrapper around information, and that information has now become a commodity thanks to generative AI.
So Datadog provides deep integration into a complex workflow. Chegg just provides answers.
And that's the bifurcation point for investors in the software space right now. Is the software company you own selling information which is rapidly becoming free? Or is it selling process management, which is becoming more valuable than ever?
That's a crucial distinction, information versus process. So if I'm looking at my portfolio of SaaS stocks, I need to ask, does this company sell an answer? Or does it sell a tool to manage complexity?
That's the billion-dollar question you should be asking for every single one. And we saw other winners that fit this mold. Shopify, ticker SHOP, up 10%. They don't just give you a website, they manage the entire complex process of e-commerce.
Right. Payments, shipping, inventory.
All of it. They are a process company. And then you have the hardware side, the picks and shovels. We have to talk about Vertiv, ticker VRT. We've talked about them before on the show.
The picks and shovels play. Or maybe it's the fans and wires trade. They're not the sexy part of AI, but they're essential.
They're absolutely essential. They make the thermal management systems, the cooling solutions. You cannot run an NVIDIA Blackwell chip in a standard server rack. It will literally melt.
It generates too much heat.
Way too much. You need specialized liquid cooling. You need Vertiv's high-density power distribution units. And their earnings report was a blowout.
They raised their guidance significantly, right? I saw the 2026 EPS number is now looking like close to $6 a share.
Yes, from $5.97 to $6.07. And maybe more importantly, their backlog is at a record high.
Yeah.
This tells us that the CapEx supercycle, the massive spending spree by Microsoft, Google, Meta, and Amazon, is nowhere near over.
So they're still building the data center factories.
We are still pouring the concrete and installing the AC units. We haven't even really started mass producing the widgets inside yet.
Which implies that a company like Vertiv has a growth runway that lasts a lot longer than just the next quarter.
Unless you believe the hyperscalers, Google, Amazon, etc., are going to suddenly stop investing in AI.
Which they can't. It's an arms race. It's an existential arms race. If they stop, they die. So Vertiv is sitting in the absolute sweet spot of this whole revolution.
Okay, so to summarize the tech landscape for today, the cell software panic was probably overdone, at least for the high-quality names like Datadog and Shopify. Jensen Huang is right. The better the oven gets, the more ingredients you're going to want to cook.
But if your business is selling a recipe book that a chatbot can replicate for free, like Chegg, you are in deep, deep trouble.
And if you're Vertiv, you're selling the electricity and the ventilation to the whole kitchen, and business has never been better.
There's one more disaster we have to mention, though, just as a cautionary tale for everyone. Kyndryl, ticker KD.
Oh, boy. Down 42% in a single session. What happened there?
This wasn't about AI. This was about something much more fundamental and much scarier. Accounting. They delayed their 10Q filing. They flagged material weaknesses in their internal reporting controls. And to top it all off, the CFO left the company. Wow. That is the unholy trinity of investing red flags. A delayed filing, an admission of accounting weakness, and a CFO resignation all at once.
If you see that trifecta, you don't ask questions. You don't try to find the bottom. You just get out. Accounting issues are the ultimate cockroaches. There is never, ever just one.
That's great advice for any investor. Okay, we've covered the jobs report skeleton, the K-shaped consumer split, and the AI software defense. Now let's bring it all together. What does a trader actually do with all this information tomorrow morning? It's time for our daily investment insight.
Let's call this strategy the bifurcation play, or, if you want to keep it simple, trading the K-shape.
I like that. So we've established pretty clearly that the consumer is not a single block. The economy is splitting. So how do we trade it?
The setup is based directly on the earnings divergence we saw today. We know the high-end consumer is strong and the low-end consumer is weak. So the first leg of the trade is to go long or to buy the experience and premium sectors.
Okay, give us the names. What fits into that basket?
Well, based on today's action, you're looking at companies like Ferrari, RACE, and Marriott, MER. These are companies with proven pricing power selling to a customer base that is not price sensitive at all.
The top of that K.
The very top of the K. I would also lump the essential infrastructure play in here as well. Vertiv, VRT remains king, because we know the CapEx spending from big tech isn't slowing down. That's a durable trend.
Okay, so the long basket is luxury goods, high-end travel, and data center infrastructure. What about the other side? What are we avoiding, or for the more aggressive traders, what are we shorting?
The other side of the trade is to avoid or short mass market discretionary. Specifically, you're looking for companies that rely on high volume sales of physical goods to the middle class.
So Mattel, MAT, is the obvious one.
The pen is the poster child for this trade right now. I would also keep a very wary eye on companies like Ford, given their struggles in the mass market EV space, and even some of the ride shares like Lyft, LYFT, that rely on discretionary spending from average earners.
Because if those revised job numbers tell us anything,
it's that the foundation for the average worker is much shakier than we thought 6 months ago. They will cut back on toys and expensive rides before they cut back on groceries or their Spotify subscription.
So the strategy, in simple terms, is buy the top of the K, short the bottom of the K. Don't bet on a broad average recovery. Bet on the inequality itself.
It sounds cynical to say it like that, but the market is a cold, rational mechanism. It pays to align your capital with where the money is actually flowing, not where you wish it were flowing.
And before you go pressing any buy or sell buttons on your brokerage app, we absolutely need to say the magic words.
The content of this podcast is for informational purposes only. Everyone's financial situation is different, and the thoughts we provide here may not be applicable to you. We are not financial advisors. Please consult with a professional before making any investment decisions.
There it is. All right, let's wrap this deep dive up. What a day. What a morning.
Truly. We started with what looked like a confetti cannon jobs report of 130,000, only to find out the history books for all of last year were rewritten downward by hundreds of thousands of jobs.
We saw the consumer split right down the middle, a Ferrari zooming past a stranded Mattel toy car on the side of the road.
And we watched Jensen Huang step up and defend the honor of software stocks, proving that in the age of AI, you still need good ingredients if you want to cook a meal. The oven isn't enough.
I want to leave you, our listener, with one final thought today. A provocative one, I think.
Go for it.
We all cheered that 130,000 number this morning. It sparked a huge rally. But given that the Labor Department just publicly admitted they overestimated last year's job growth by nearly 400,000 jobs, can we actually trust the number we just celebrated?
A very fair question.
Are we going to be sitting here in February of 2027 doing this exact same deep dive and talking about how they just revised down the great January of 2026 that everyone got so excited about today?
If history is any guide, the eraser might already be hovering over the page.
Something to mull over while you watch those green arrows. Keep your stops tight and your eyes open. This has been Theta Fuse.
See you on the next one.